Hey guys, it's Andrew from REI Live and the Deal Finders Club. Hey, we're going to talk about cash a little bit, but we're going to talk about offers. What makes a good offer? A couple of our students and some of our staff, we were talking about what makes a good offer when we're still getting multiple offers on our properties right now, and we're trying to figure out what's the best one. What should we go with? Yeah, we know cash is king, right? We all love to see cash, but they're not always cash, and just because it's maybe a conventional loan doesn't necessarily mean it's bad. All right, depends on your property, okay, and it depends on your timeline, right? So there's things to evaluate with the different types of offers. And remember, if you're a buyer, you want to make your offer look more appealing. So we're going to give you the hierarchy. We're going to give you the rankings of what these are. I've got 6 of them here, plus a little bonus at the end. So number 1. I got it up here already. Cash money. All right, cash money, cash is king. What's the benefit of cash? Oh, let me just kind of break this down. It sounds nice, right? Great. It sounds wonderful. But that's not why people want to take a cash offer. The cash offer means the buyer should have cash available. They should be able to provide a proof of funds, which means they don't have to wait for a lender. They don't have to wait for someone else to come and say, yep, we're ready for you to close. They should be able to close just about as soon as the title work is ready. The closing attorney or the title company is ready. So should be a quick close, right? They also don't have to jump through any other hoops, right? So they don't have to get an appraisal. They don't have to get a clear CO 100 letter for someone else to say, yes, I'm okay with you buying this house. There's no third-party approval. It's just their money, their decision. They've already made the decision, put the offer in. So you kind of hope that you're going to follow through and buy it, right? So that's what's great about cash. Speed, and there's nobody else involved. It's just your buyer and you, the seller. You don't have to worry about those other people coming in. All right, so that's what makes cash great, okay? And, if it's a bank holiday, it doesn't matter. The cash is there. They can write the check the day before and we'll be ready to go, okay? So cash is king, and it's king because of convenience, really, and speed. We don't have to worry about everybody else, okay? That's why wholesalers, we say, hey, we'll buy it cash, because sellers know that that's more convenient. It's easier. All right. Number 2 is private money. All right. Private money. What's the difference? What does that mean? Private money usually comes from friends, family, close connections to the buyer. Okay. So if I was to offer you $100,000 for your house, and I said, yeah, I'm going to use a private lender, someone that I know really well, someone that's local, someone that's not a company, not a bank, right? That's more appealing to me as a seller, to you as a seller, because again, it should be more convenient. That private lender you can also ask that private lender for proof of funds. The private lender is probably not going to go through or ask for all those hoops. They're probably not going to ask for the CO 100. They're probably not going to go, if they do ask for an appraisal, they'll have less stringent rules to go by usually, right? They're lending the money to the buyer because of the buyer, not necessarily because of the property. All right, they know the buyer, they probably know they're going to fix it up, or they know their business, that kind of thing, okay? So the private lender has a connection. They have a connection with your borrower, which should keep them and keep them loyal to that borrower, so that if something comes up, they're not going to just drop the borrower and say, sorry, you can't buy this house because there's a little termite damage, like a traditional lender might do, okay? So the borrower in a private lender situation should have a lot less paperwork and a lot less headache for them as well. So hopefully they will be able to close faster. Again, maybe not an appraisal, definitely a lot less third-party investigation. Okay, so that's your private money. Then you got to think about hard money. All right, hard money is, I would say, number 3. Hard money is different because hard money is coming from a company, right? There's big LLCs, there's big companies that lend to investors. They lend to investor borrowers specifically. They know what the investor borrowers need. So they are very helpful for investor borrowers, which is great, especially if you've got a property that needs some work. That may be a rental property or just is beat up or something like that. A conventional loan probably won't qualify, right? That termite letter or the livability letter from the FHA people, whatever they do, the appraisers, that say I can't live in it because the windows won't lock, whatever that stuff is, that hard money lender is probably not going to get that type of inspection. So less paperwork for the borrower than a conventional mortgage. So what you'll see is this kind of paperwork kind of decreases as you go up, right? So as we go down, cash, like no paperwork. Private money, a little bit of paperwork for the borrower. Hard money, a little bit more paperwork, but you're going to see it gets more and more for the borrower as we go down. All right, so they should be faster. Hard money lenders are faster. They know that their borrowers want to work fast. They work on speed because when they churn the dollars, they get paid more. So they want to work on speed. And again, the loyalty factor. Hard money lenders usually work with borrowers multiple times. They know that investors are going to come back and come back and come back. So there's actually a bit of a loyalty factor there. So they want to help that borrower. Where conventional loan writers, conventional banks and things like that, you're just more of a number. Like, yeah, they kind of want to be nice to you and they kind of want to be loyal-ish because maybe you'll buy another house in 20 years, but it's not their driving factor. So if speed bumps come, they're not really, the conventional lenders aren't really going to break their backs. They're not going to really work real hard to save a deal, whereas these hard money lenders, they will, because they know that their borrowers will come back over and over again. All right. So remember, as a seller, you're evaluating these to see, well, if I have one offer that's hard money, one offer that's cash, which one's better? All right. This is how we rank them. Okay. Number 4, we're getting into something you're probably used to. And I think I spelled it right. It doesn't matter. Conventional. All right. So a conventional mortgage, you get an offer from a real estate agent, it'll say on there conventional mortgage. That's what everybody is used to, right? It's a 30-year fixed rate, adjustable rate, whatever. The conventional means basically it's going through a conventional lender. It's going through a bank. Most likely going to have a higher down payment than some of these. The borrower is going to have to do that whole packet of paperwork. They got a lot of paperwork to sign. They got to sign over their life, their children, their cars, their grandchildren, everything to borrow to buy that house. So they're definitely going to need the appraisal. They will get an appraisal. And crazy thing, they have all these rules about, they have to have the appraisal viewed and signed by the borrower 3 days before the closing date, or the closing date has to be extended. All this stuff. And the conventional lenders, they're busy. Like, they're just slam busy. If your property has any kind of like variance other than it's a cookie cutter, it's ready to move in, there's no issues, the buyer can buy it and move right in, the conventional mortgage and really the conventional and down is going to be a bit of a challenge. You just know you're going to run into something, okay? So if you're selling a house that needs work, as we go further down, it's less appealing for you. If you're selling something that's great, it was built 2 years ago, it doesn't have any issues, yeah, who cares? Conventional, you shouldn't run into any issues. Underwriting should be pretty simple. You just got to worry about the borrower at that point, and that is what it is. So, all right, so here, you got more paperwork. As we go down, it's got more paperwork. You got more third party. You're going to have third-party people looking at it, appraisers and inspectors that all have to approve. They all have to submit their reports, all that stuff, okay, as we go down. All right, I'm going to throw this one in here because this is what got us talking on this topic, was the 203. Now, I'm not going to go through the full explanation of what a 203 is. I'm not going to tell you how to apply for one. You can certainly look that up, and maybe I'll make a video on that later. But the 203K is a loan it's a government-backed loan. So we're going to get down to the government-backed products here in a second. It's a government-backed loan that allows you to build in rehab money. Okay, so why is this different? Why am I separating this from the other government-backed loans? Because when you build in rehab money, now the underwriters know that there's renovations going to take place. they know that some of the issues that might be in that house can be addressed through the renovation. Now, I will say that I put it up here. I don't know. It could go back and forth. I put it up because there's flexibility with the quality of the house, like the livability, the issues, the things that might be repaired. There's flexibility there. The downside to this is it's going to take much longer because your borrower has to go get approved scope of work from contractors and that sort of thing. This is going to take a lot longer, a lot more third-party intervention here, but again, much more flexible with what's going on with your property. So we were selling a house that we knew needed work, and we were like, no way are we going to take a FHA loan. Well, they come in with a 203, and we're like, okay, we can handle that because we understand that they know they're going to be getting some work done. They have to live in it as well. Okay. All right. So let's get down to the government-backed loans, which is FHA, VA, USDA, AAA. I don't know what else is out there. I think this is it. These are your most stringent. These are going to be the hardest to, if you have issues in the house, if there's things that need to be repaired, you're going to have to fix them before the people close. All right, these folks are going to force you to do repairs that maybe you didn't want to do. They're going to force you to fix some feels like minor things as a seller. As a borrower or as a buyer, you're like, yeah, fix all that. Yeah, I want all my windows to open. Whereas as a seller, I'm like, look, seriously, you got one in every room, whatever, you're fine. So these are those folks that are going to make you do that. So these repair addendums, just be ready for a heavy repair addendum. Go ahead and prepare yourself. If you're an agent, you better prepare your seller, prepare your buyer that the repair addendums are going to be big. And they're going to take a little bit longer than the conventional, and of course longer than everything else up here. I think 203 will be longer than these because of the other folks, the inspectors and the contractors that have to be involved here. So I don't know if this is all of them. I am not a mortgage broker. I don't do mortgages. I just buy and sell a lot. Okay, and this is what I see. All right, so this much, if I'm a seller, less desirable. I don't want to see it. Of course, I'll sell it if I got to, but if I got two offers, they're the same price, and it's conventional in this, or if it's these two, whatever it is, I might even give a $5,000, $10,000 price difference based on these two. If I know that my house needs work, 100% we're going up here. Okay. If it's a great house, moving ready, the thing's been, we did a full flip on it. Oh yeah, sure, we'll do this. As long as we think that we've held it long enough. So that's what we evaluate. If I'm a buyer, I want to throw this out there as much as possible so my offer looks the best. Okay, so be ready to use cash. Get some private lenders, get some hard money lenders, get your cash money in order. Okay. Oh, I told you I would do the bonus. What's the bonus? All right, the bonus is seller finance. All right, this could be the best, could be the worst, right? It's a bonus because all 100% depends on you, your goals, your situation, your property. I love it when someone comes and says, I want to do a seller finance. I can put 20, 30, 40% down, but I just can't, I know that they may not say it, but I can't qualify because I'm self-employed, whatever it is. We love that. As some of the properties we've held for a while, especially our rentals that we're selling now after holding them for a number of years, we love doing this. The banks make the money, all right? They have the tallest buildings in town for a reason. So if I can be the bank, I will be the bank. Now, I can't always be the bank. If I just did a flip and I used hard money to buy it and renovate it, well, I can't seller finance out of a flip. I'd have to pay them out and then carry the note for the buyer. Okay, so that doesn't really work most on that situation. But if it's one of our hotel deals, and we bought it for $20,000 and we're listing it for $60,000, and somebody wants to bring and pay $25,000 and finance the rest, Oh yeah, this shoots right up to the top. All right, so that's where we're at. That is how we evaluate offers and how we make offers based on how pretty we want our offer to look. So next time you get an offer on your flip house or something you've been holding on to for a while, just come back, take a look at these, and go through it and figure out the pros and cons of each. Write them down, make a decision. You know what? I will add in the comments. I'll add in the link. If y'all would just let me know in case I don't do this. We have a really amazing tool when we get multiple offers. We have an awesome little tool. It's just a spreadsheet where we put all the pertinent information so we can see them all lined up next to each other, and we can compare seller finance, conventional cash, whatever it is, and we make our decisions that way. So that's a really sweet tool. If you're an agent, you should have it for all of your clients. If you're a flipper or somebody selling properties, wholesale, whatever, you should have it so you can compare everything in one location. So let me know if you need that. I'd be glad to give it to you. All right? Hey, looking forward to seeing y'all at REI Live Columbia. If you are in Columbia, South Carolina, or anywhere close to our market, you want to come hang out with us. Looking forward to seeing you there at the next one. Join us on Facebook at REI Live Columbia on Facebook, and you can check us out at reilivecolumbia.com. All right, talk to you soon. Bye.